So as I was trying to put together material, I thought, what is going to be most valuable to people? And I think one of the things that we hear all the time is how difficult it is for investors to try to do due diligence. It's not your job. It's not something you guys spend your days doing. So it's difficult if you're not in the real estate space. You know, some of you are very sophisticated real estate investors and others are not. So I thought I would put together something that kind of helped walk you through how to do better due diligence on managers. Quick thank you again to our sponsors, help make it possible. Please engage with those folks. You're going to hear from them a little bit later today. I wrote a book a few years back called Capital Attraction. It's out there on the table for you. I defined what it meant to be. What we labeled it, and we don't use this term much anymore, but we called it a small balance real estate, basically meaning non-institutional size, which is the vast majority of the market. And a small balance real estate entrepreneur is somebody who raises money for a living, whose business is to acquire assets of one type or another, real estate assets, that requires them to have to go out and raise capital from investors on a regular basis in order to fund those assets. So that's what we called a small balance real estate entrepreneur. There are all types of asset strategies: multifamily, retail, office, storage, hotel, loans, discounted notes, buying houses and flipping them. I mean, anything you can think of in real estate, there are managers out there that do it, and it's a very capital intensive business. If they start getting good at originating deals at any scale, it requires them to go get more and more and more capital. So they really have an insatiable appetite for money, but unfortunately they can't really get it from institutional investors. So high net worth people are their primary audience. So I pulled a few stats to give you the size of the market, give you some sense of it. The estimated total dollar value of US real estate is somewhere around $20 trillion. The aggregate small cap commercials less than 5 million or less than 50,000 square feet, or in the case of multifamily, less than 40 units, is about 3.4 trillion, which is a big number. And then middle market, and I get these statistics from some different places that we use from time to time. The size of the middle market is somewhere around 95% of the market. So depending on what statistics you believe, somewhere in the range of 10 to 15 trillion dollars worth of real estate is in what I would call middle market. And then to try to get some idea of the size of the number of managers that are out there, it's very hard to get that number. I don't really see any reliable evidence, but the people come and go all the time. There's a publication called Private Equity Real Estate, and I looked that up the other day. There's 2,589 GPs or managers in the United States, and people that list in PERE are generally higher, more institutional-looking managers. So that gives you a size of, or an indication of the size of the market. And I call it unofficial estimate, is somewhere probably north of 50,000, and it may be even higher than that. And these are small balance real estate managers, people that are around the country raising money from high net worth investors on a regular basis to fund whatever deals they do. So it's a big market. And again, high net worth investors is really their primary option. They can't go get institutional money. They're too small. There's all kinds of reasons that I won't bore you with, but suffice it to say that where they have to go to get that capital is high net worth investors like the people in this room. This will just give you a sense of the choices that you have. So you just have so many things going on that you have way too many choices to pick from. And usually when people have too many choices, they don't make any decision. But there's all kinds of manager strategies. So how do you pick one from the other, right? It's very difficult to pick one from the other. They all kind of look the same, right? It's like you listen, you hear, but you're really not sure what's what. And unfortunately, there are some wolves in sheep's clothing out there that you want to try to pay very close attention to. It's hard to know which one is which, right? So all of this means that you should try to learn as best you can how to at least do some basic due diligence when you're making decisions. So, Mark Twain said it's easier to fool people than it is to convince them that they have been fooled. And I find that to be very, very true in the small balance real estate space. So what I'm trying to hopefully help you guys do today is to not get fooled as easily as many managers can fool investors if they're so inclined. Okay, so with that, I'm going to give you 10 top tips for how to do better due diligence on managers. Some of these may seem fairly basic, and yet, like a lot of things in life, sometimes the most basic things are the most neglected. So I'll walk you through these. I'm going to try to leave some time for questions at the end, so I may go through this quickly, and you can take notes, and if you have questions, I'll definitely take questions at the end of this session. So tip number one, I'd say focus on the manager first and the deal second. You see a lot of investors that get seduced by the deal. Too many investors kind of jump straight into the deal and they don't pay enough attention to the manager. I would say with managers, you want to really focus on how do you decide one from the other. Don't fall for slick marketing, fast talk. Make sure you're listening and paying attention to the manager. It's a big problem, and I think that's why I start with the manager. That's why I'm starting with that this morning, and then you'll see this afternoon we'll get into some more due diligence on specific individual deals. So always start with the people, the jockey. It's more important than the deal itself. Tip number two is be clear on your own personal objectives. What are you looking for and why? I mean, it still amazes me to hear people talk about what they say they want, but then how they actually act. I see a lot of people that are, call them IRR shoppers, right? You see a big fat IRR number, and that's how people make their decision. No matter how much people say, hey, I want cash flow, but then you see the IRR looks like it's 25 or 30%. People jump in. So don't be seduced by IRR. Be clear on your objectives. Are you looking for income? Are you looking for capital gains? Are you looking for tax benefits? Do you have certain preferences that you like around geographic areas or property types? So I would start with that. So if you pick your manager first, make sure you're clear on your objectives. Again, very basic, but very neglected. Then I would say no guessing. Many people don't really even know what they're looking for in the deal to begin with, and so they tend to just take things at face value and not really pay much attention to the deal. So I would say to you, do your homework somehow, some way. Do as much homework as you possibly can. Don't fall prey to FOMO, fear of missing out. I see a bunch of these crowdfunding sites that put out the deal, and they brag about the fact that the deal filled up in 12 seconds and that the investors, so you basically have no time whatsoever to make a decision. So people then end up rushing in. It's like, how fast can you click the button to get into the deal without even knowing what the deal is all about? So in my mind, like, that's not something from an investor perspective. From a manager perspective, they love that because it fills up quick and they don't have to spend as much time. But from an investor perspective, I would encourage you to do your homework. Try to get some information from the manager about the important issues that a lot of them, they want to give it to you, they're willing to give it to you, but it's difficult for them to do it. You need to be the one to reach out and make sure that you get the information from them. 4, start with a simple Google search. And I would encourage you to search on any principle of the company. So if there's 2 or 3 or 4 principles, search on all of them independently, not just the company itself. We do this all the time, even when we're looking at managers, is just start by looking online. You can find a tremendous amount of information online, and I've seen people invest with people that if you had done a Google search, you would, just that by itself is a great place to start. And I would encourage you to go past the first page, like go to the second page and the third page and see what you can find about these managers. Oftentimes you'll find things that are interesting. And I would say, nobody's perfect, right? You're not looking for saints or Puritans. I mean, everybody's got something going on. And if you're in business long enough, generally something's going to happen. Somebody got mad, somebody sued you. It's not so much you're looking for people that have never had anything. You just want to make sure they don't have anything really bad that you could have found out in 5 minutes. Okay, so look them up on social media as well, if you can. You can also find out a lot about people by looking on some social media sites. LinkedIn and other places will have quite a bit of information. Again, simple but effective. Okay, number 5, I'd say get background checks on managers if you can. This can be harder to do, and I'd say part of the challenge from a manager standpoint is that from an investor standpoint, if you're investing $50,000 or $100,000, that's a significant amount of money. but to a manager who's trying to fill up a $3 or $4 or $5 or $6 million deal or a bigger fund, that amount of money doesn't move the needle that much. And if you have to do that over and over again with a lot of people, it ends up becoming very challenging and difficult to have that many conversations. So it can be hard for people to spend the time with you individually that you need to do. So hopefully, if they're good, they're assembling this information and disseminating it in a way that they can do it one-to-many and not just one-to-one. So what it should mean, though, is if they're good, they have this kind of material available to provide to you if you ask for it. Verivest has background checks on managers. To be Verivest verified, managers have to pass a background check, do that once a year, and it's any principal of the company that owns more than a certain percentage or is operating in the business itself. So I would request and see if you can get background checks, see how people react. Some of it is how do they react when you ask them for this kind of information. If they're stumped, that is probably a problem. Either they can't provide you one, or they don't want to provide you one, or they haven't thought of it. Anyway, in any of those scenarios, in my mind, that manager needs to up their game. Get some evidence of their track record. This is even harder. We also do this type of work, and it's incredibly difficult. I'm constantly amazed how hard it is for managers to provide information that can actually corroborate the claims that they make about what it is that they've done in the past. And I would say for the first 10 years, we were guilty of it too. I mean, you do the deals, you have this level of performance, but you don't necessarily track it in a way that you can make it available to your investor base. So I would tell you to try to ask them for a track record, even if it's something that they provide to you that has not been corroborated. That's better than nothing. It's at least a starting point. How many deals have you done? What have been the performance of these deals? What's been the worst deals that you've done? And if people give you something and they've been in business for any period of time and there's nothing on there that ever had a problem, in my mind, that's a cause for concern. So at a bare minimum, they should be able to provide you with something that's internally generated, but that's not ideal. Something that would be ideal is something that has actually been verified or corroborated by a third party. Again, Verivest does this. I will tell you that this is probably one of the most difficult things that we have attempted to do, precisely because it's difficult for managers to provide the information. And then I will tell you that when they do provide the information that they think corroborates the track record, oftentimes it's not anything that's actual evidence of what it is that they're representing. And we have to go back and ask for more and more and more. It's very, very hard. But I would encourage you to try to at least get some sort of representation of a track record, and if it's humanly possible, try to have it corroborated independently. Audits are okay, but I'd say they're rare. So the smaller the manager, the less likely they're going to have an audit. And an audit generally looks backwards in time at their accounting practices and isn't likely to corroborate individual performance of individual assets. So there's another thing called a DDQ, a due diligence questionnaire. I'd say most small managers will not have one of those. But if they are trying to get institutional money, then they absolutely unequivocally will have to have a DDQ, a due diligence questionnaire. And it goes into all kinds of depth about how long they've been in business, how long they've been together, background check, track record, et cetera, et cetera. So good question to ask is, do you have a DDQ? And I tell you, percentage-wise, I'd say that number is going to be very small. But at least get some representation as best you possibly can of what it is that they've done in the past. And the lawyers will tell you, rightly, that past performance does not equal, future success. But as everybody knows, generally speaking, things that have happened in the past will tend to continue to happen in the future. People who do things well tend to continue to do things well. And people who have had problems oftentimes don't get a lot better in the future. Ask for access to a data room. A data room is a portal that a manager should be able to provide to an investor that has material in it that would be beneficial and useful to that investor. And it's a way for them to provide information one-to-many instead of one-to-one. There are programs, software out there managers can buy that allow them to do this. We at Fairway does it. Many other managers I know do it. Again, the smaller the manager, sometimes the harder this is to be able to do. But a data room enables them to assemble information that they can give to an investor and allow you to go in and see things like background checks, track records, principal bios, history of performance of transactions. And then at the deal level, it enables them to provide all kinds of information about the deal. I won't get into much to due diligence on individual transactions. Darius is going to lead a discussion on that this afternoon. But having that access to that data room, when you ask them if they don't have one, I would ask them why not? Because if they don't have it, then how are you going to get the information? Are they going to email it to you? Are they going to send it to you in attachments? You know, it can be very difficult if they don't have access to a data room, so ask for that. Get references from them and check around. Talk to other investors if you can who have invested with that manager in the past. I would say, if possible, you try to triangulate in some way to figure out investors that they have that they didn't necessarily give you, which can be difficult, but if you can do that, you find people who have invested with that manager who aren't hand-delivered to you by that manager, you can get some straight information, hopefully, from those people. Reviews, if they have them, it's another thing we've experimented with, I'd say with mixed success. At Verivest, which is allowing investors to provide reviews of their experience with various managers. You can find out who is their counsel, right? Who is their securities counsel, who's their CPA, and is there any way you have any connection with those people? And if so, can you triangulate investor experience from the service providers that they use for their fund or their syndication? So as best you can, if you can get references on those managers and check around, you will be better off. Another thing I see more and more investors doing these days that I think is helpful and powerful for investors is to form entities and co-invest with other investors. So as opposed to coming in as a single individual with $50,000 or $100,000, if you have, and there's people in this room that do this, they assemble several people together, form an entity, an LLC. Somebody manages that LLC. 5, 6, 8, 10 people put money into that LLC, and then you come in as a single investor into the fund or the syndication on the part of the manager. Now, why would you do this? Well, among other things, it gets multiple people involved, so you can tend to do better due diligence if you've got more investors looking at it. And a big reason to do it is it increases your ability to negotiate with that manager more effectively, because that manager is much more interested in $1 million investment than they are in a $50,000 investment, right? So having an entity that comes in is something that can be a very powerful thing to do. There's an analogy in the startup space called AngelList. Has anybody heard of AngelList? So we got a few people, not very many. AngelList does this, and they help facilitate syndications, which is basically setting up investors' ability to come in, pool their money, and come into a transaction. So we're actually working on some of this stuff at Verivest. I'm going to talk a little bit more about that this afternoon. But this can be a powerful way for investors to do better due diligence and increase your bargaining position with managers. And the last one here is, if it sounds too good to be true, it probably is. I have had over 30 years, and it's really, I guess, since '99, we started doing one-off deals. I've had a lot of investors who, you know, we're not the only people that they invest with, so they'll talk to me and compare, hey, I'm looking at this and I'm looking at this, and then I'll ask them what else they're looking at, and I hear what they're telling me, and I know instantaneously that there's something wrong with it. And yet, they'll be seduced by it sometimes because it sounds so good that they just can't help themselves. So I'd say, just if you can discipline yourself that if it sounds too good to be true, be very careful. So if you interest rates that are way out of line with what everybody else is doing in the market is a bad sign. So be very careful when you hear things. And I would compare apples to apples and not apples to oranges. Like sometimes people will say, oh, you're offering a 8% return on your notes and a senior position in the fund, but I've got 12 over here. I'm like, okay, well, what is 12? That's 8 versus 12. Okay, I'll take 12 instead of 8. But what risk am I taking for the 12 versus the 8, right? And if you don't understand the difference in the risk that you're taking, the 12 could be a way worse deal than the 8, right? And again, depending on your objectives. So I'd say compare apples to apples and don't get greedy. Because when you get greedy, here's what can happen to you. And I've seen this happen to investors, is they got too greedy and they ended up with a wolf in sheep's clothing. Bonus tips. So I got a few bonus tips. Get some information from the manager if you can about how they'll report. In the private investment space, there is no requirement. There's no legal requirement for them to provide any sort of reporting to the investor. Okay, the only thing they really have to provide you is a 1099 if it's debt and a K1 if it's equity. It has become more common in the last few years that more and more managers are providing a lot more information because it's becoming more accepted or more required in the marketplace if you want to raise capital in the first place. But in the private space, the reporting is going to be all over the map. Ranging from you get absolutely nothing except your K1 at the end of the year to you get quarterly reports. And I'd say anything more frequently than quarterly is an unrealistic expectation. But if you can get managers who can consistently provide quarterly reports and quarterly information, financial statements, P&L, balance sheet, and some sort of qualitative narrative about what's going on in the fund or the asset or whatever, that's a very good cadence for a manager. So if you have some idea of what you can expect going in, that's helpful. I try to understand their team and their systems. Like how many people do they have? What do those people do? What are they capable of doing and not capable of doing? Is this a 2-person team, an 8-person team, a 10-person team? Asking a little bit about what it is that how are they going to manage the assets once you've invested in them? Because once you're in, now you're in, right? And whether it's this individual deal or a fund, once you're in, you are in, and you need to know how are they going to be able to manage those assets. Learn how to evaluate fee structures properly. I'm not going to talk about that in this session. I think Darius is going to cover some of that this afternoon. These are a very sensitive topic for both investors and managers because, of course, fees are how managers make money. Investors don't love fees, but you have to pay some fees because if you don't pay some fees, how are they going to function and be able to deliver returns if they don't have income coming in to do the work necessary to deliver on those assets? So there's a balance between what's reasonable and what's not. And I would say what's reasonable in the small balance world is different than what's reasonable in the institutional world. And sometimes investors apply institutional standards to small balance managers, and it's not realistic. But yet this is a battle that you will fight all the time as a manager is on fees. So learn how to adjust to understand them as best you can. And look for alignment and skin in the game if you can. This varies significantly from one manager to the other. Especially newer managers, they don't have as much money to put into their deals. That's not necessarily a bad thing. We've had a lot of success with younger, newer, emerging managers because sometimes they have unique niches and they try very hard and they may not have a lot of skin in the game. Others will put a lot more into it. You want to try to it's at least worth asking and trying to understand what that looks like going into that deal. Okay, so let me open it up to questions. We have about 20 minutes left. Yes, sir. Mr. Aldrich.
Pretty simple question, but you've mentioned those who have been qualified by Verivest, but then there's a gold standard for which you qualify people. Is that correct at Verivest?
Yes. The Verivest verified means that they have passed the background check. So they've met some minimum standards of the principals passing background checks. Gold means their track record has been verified to a set of standards that we have articulated in our terms of service. It doesn't mean we've verified every deal they've ever done. It means we've taken a sampling of their lifetime of deals and we've taken steps to verify that the information that they're saying about their track record based on what we can find is legitimate. So it's not a foolproof method, but it's better than just about anything else that I can find in the marketplace. So to the best of my knowledge, there is no, especially in the small balance space, there is no third party that's going to go out and do track record verification for small managers on behalf of investors. That's an incredibly challenging thing to do. But that's what gold means, is that people have engaged us to verify their track record to our set of standards. Yes.
Oh, thank you. So we followed those 10 golden rules, and say an investment has not gone well, what would be your advice in backing out or exiting?
Well, generally speaking, in the private securities world, there is no backing out. You're in, and then you have to do the best you can to manage through it. And I mean, I could tell you direct stories that I've seen where investors come into a deal with a manager, it goes sideways, the manager disappears, you can't get a hold of them, you're in with 6 or 10 or 15 other investors that you don't even know, you don't even have their names or numbers, and now you can't get a hold of the manager. Now what do you do? I mean, I've seen that situation many times, and it's a bad position to be in, right? So you want to pick wisely. There's not a lot you really can do. You can call a lawyer, they can try to track the person down. What ends up happening usually is the investors, and again, I'm not a lawyer, so I'm not going to give legal advice, but I believe the manager has some obligation to allow the investors to know who the other investors are. But if the manager's not returning your phone calls or your emails, it's pretty tough to get that information. But what it usually ends up happening in that scenario is the investors will get together and try to figure out how to manage their way out of it. And somebody will take the lead. Bill Skalak's in here somewhere. I remember Bill telling me a story, right? You had one deal down in Arizona somewhere where you had to step in and you figured out who the other investors were, and then somebody comes in and takes the lead and you get the manager out of there, which can take months or years. And then you do the best you can to manage the asset. The best advice I would give you is try not to get yourself in that position in the first place. Yes, sir.
Hey, Matt, I wanted to go back to the gold. I think you're saying that the sponsor hires you to verify on the gold. It's something that is an option for sponsors that they engage you to do that next level.
That's correct.
First thing, and then when it gets the gold, that means that the track record they're representing is accurate. It doesn't necessarily mean it's good or bad. It's just that you verified from a sample that it's accurate, right?
That's correct. And even when you say that it's accurate based on the criteria that we lay out in the terms of service, which means we didn't verify every piece of information. There's some latitude on what constitutes actual verification because it's all over the map on what people can actually provide you. Yeah. So there's still some judgment there. And I will tell you that we're struggling at Verivest on this track record piece because it's just incredibly difficult to get the managers to give us the information in the first place. And then when we do get it, oftentimes it's not actual verification. It's spreadsheets with numbers plugged into them that might be accurate and might not. But when you start asking for closing statements, right, tax returns, bank records to show distributions that were made, because how do you calculate the performance of an asset? I mean, or an IRR of a deal that you held for 5 or 6 years, right? You have to capture all of the distributions that were made over all of the lifetime of that asset, plus what they sold it for at the end. It's very difficult to get all of that information from them. So, and honestly, it's like the amount of time that it takes us to do that. Most managers aren't willing to pay the costs associated with the amount of time that it takes us to produce an accurate track record. So we've explored and we are exploring how do we automate this and build software to be able to do it, but we haven't. That's an expensive proposition. So I would tell you that it's about as good as anything I know of in the marketplace right now, but it's not foolproof. And for individual investors to try to verify somebody's track record, it's next to impossible.
And there is no silver or bronze. It's either you're
That's
there
correct.
or you're not.
That's right. Yeah. Hey, your track record's sort of accurate.
Yeah. And the second thing, when you talked about trying to do background checks, if you've verified somebody, should we in this room try to verify it ourselves, or is that just you've done a good enough job that we don't have to?
Yeah, I would say that, look, you can go to differing levels of depth of a background check, right? You can get something online that's pretty mild. You can do something that costs more money, and all the way to hiring private investigators, right? There are several programs, LexisNexis and others like this, that you can get this kind of information, online, just for subscription costs. And then we actually use a third-party service that does it, so it takes a little bit longer. But yes, I would say I wouldn't say you need to go out and get another background check. I mean, is it possible that another background check would reveal something that ours didn't? That's possible. But it's probably not worth the effort. And even if they aren't Verivest verified, look, and like I said, there's 50,000 managers in the world, and we only have, a few hundred on our platform. So you're going to meet all kinds of managers that don't have anything at Verivest, right? How are you going to? I'd ask them if they have a background check, see if they've even, to some degree, have they even thought of the concept, and see how they react. And some will do it, and some have them, and they provide them on their own. Some will put them in their data room. Like that's what we'll do at Fairway, is we just have all that stuff, and we do it on a regular basis. It's in our data room. So when we provide an investor with the information, you can see it in the data room. Now, if somebody's going to go so far as to fabricate and manufacture their own background check, okay, now you're really dealing with somebody who's hell-bent on ripping your leg off.
As a comparison, you mentioned there's we're in the sort of mid market, small.
Mm-hmm.
What do the big guys do? What do they do as a counterpart to Verivest?
Oh, they have teams of people that are on their staff that do all of this stuff on every investment that they would make, right? But they won't even talk to most of the managers that are small, because they can't. I mean, they don't want to deploy any less than, 10 million would be a small investment, 25 or 50 or $100 million, right? And they don't want to be more than 10% of the fund. So if you don't manage $2 billion, it's like you don't even get in the door. So they have teams of people to do all this stuff.
So it's all done internally. There's no service counterpart to Verivest.
No. I mean, now they may hire third party, there's you can hire people that will render legal opinions and so forth. There's a group, Mick and Associates. You can get a Mick report is something that's pretty common in the industry, right? But so you can hire third parties to go do that kind of stuff. That's expensive.
Matt?
Yes.
The gold standard for institutional allocators is Mercer certification.
Yes.
So if you're a pension plan, a sovereign wealth fund, a family office of hundreds of millions or billions of dollars, and you're looking at making a $50 or $100 million allocation, correct, a lot of times you'll get a Mercer certification.
Correct.
Some of the people that I've made allocations to make a big deal when they get that Mercer certification. And I believe it's hundreds of pages, but it may cost hundreds of thousands of dollars to get it done. So
that's
it's
correct.
not going to be applicable.
And as you mentioned that, Peter, there are also a lot of these large institutional investors will use consultants. So consultants are third-party people that do this kind of work on their behalf, and then they'll do it, and then they make that information available to the California State Pension Fund or the Texas Teachers Retirement Fund or whatever. So all of this is very sophisticated in the institutional world, but as you drop down into the small balance world, and you're dealing with small managers that might manage a few $1 million, and then their investor base is high net worths, who are people that have made, wealth in their lifetime and want to invest in private stuff, but don't do any of this, for themselves as a living. Like now you're into Verivest's world, which is what we're trying to do, is provide similar services to a very fragmented market that is very difficult to do because it doesn't have 9 zeros on it. It has
correct. The amount of money that they spend, it's almost paralysis by analysis, but they need to do it because if it goes sideways, they could say, look, Mercer said it was good.
That's exactly right.
And we got there, but it's a CYA move. It's totally 100% a CYA.
Yeah, and as individual investors, could you get into a Blackstone fund or one of these big ones? Yeah, you can. But if you're going to pick and choose individual managers, right, and you want to play ball in the small balance space, you're taking a certain amount of risk with these managers that's hard to avoid, right? But presumably the returns that you get on it are, justify those risks. And that's why people do it. And there's lots of really great managers out there. And, and some of them, it's not so much that they don't want to do all of this, it just takes a lot of time. I mean, I started off with none of this stuff, and it's taken years and years and years to even understand what you're supposed to do, and then let alone develop the capacities to do it. So, but if you ask your managers, you should be able to get some sense pretty quickly. How far along are they in that journey? How much risk are you willing to take? And even if they're not that far along, it doesn't make them a bad manager. It just you need to make an educated decision.
Matt, one other thing on your due diligence point number 8 about trying to circle back and find references that they didn't hand up to you. Mm-hmm. That's one of my pet peeves. And the 2 places where I turn most are LinkedIn. So I go to their profile, see if there's anybody that I know that's connected to them, whether it be a sponsor or whether it be an investor, and I talk to those people because you're going to get much more honest insight from a hand. And then the other place you can actually find now is something like an Instagram, where if they have either a personal Instagram or a business Instagram and you're connected with those folks, you can reach out as well. And I found those to be invaluable, and I've made some positive decisions. And I've made some decisions not to make allocations based on what I found on that.
Yeah, or you can go on Venmo and you can figure out who they paid last week and if they went down to the dispensary, and it's remarkable how much information people are willing to put out there about themselves. Other questions? Yes, sir, over here. Okay, let's go here and then over here. So
just a 2-part question. Is there any forum on Verivest for your investors that investors can talk about other sponsors that they've had either positive and or negative stuff with? And also, are there any sponsors that you dropped because they were good at one point and now they're not good, and that would be great for us to know that, okay, maybe they were good and now they're not good, and just kind of a heads up?
Yes, the answer is yes to both. It's a delicate thing, right? If somebody has a problem and we need to terminate the relationship, do we say that publicly? Do we not? And that depends on what the relationship is. Are they just listed as a manager on the site, or are they actually hire us for administration? So we actually have, under financial knowledge of things that are happening at the fund or the syndication that we don't like. So the answer is yes, and it's a delicate thing. We don't go out there and publicize it. I mean, if they were there and they're not there now, hopefully that speaks for itself. Now, there's the sponsor profiles have a rating, so an investor can go on if somebody's listed on Verivest, they can go on there and you can make comments about that manager, and investors can see that rating. The sponsor cannot, no. We can, but they cannot. Yes.
Is the lack of an online portal a non-starter for you?
With a manager?
Yes, if they're sending you Excel,
well,
Google Docs or something.
I would say at this point it would be, yes. I mean, 2 years ago, 4 years ago, no. But I mean, the whole online portal thing has grown from basically nothing. I mean, for small balance managers, I mean, large administrators have had it for years with institutional groups, but it only started happening in the mid 2015. I mean, 2010s. So now it's become increasingly common, and most managers have some sort of portal or are getting there. So I would say, look, if it was somebody I knew I met them at the golf club or something, and I knew them really well, and they were just getting started, and they didn't have a portal, but I trusted them, I like what they did, and maybe not, but I wouldn't go online and find some deal listed on a crowdfunding site and invest in it without it.
Hey, Matt?
Yes. Yes.
Steve
Over here and then over here.
In regards to third-party administrators, I think from an investor perspective, I feel good when a fund I invest with has a third-party administrator helping to prepare the statements and the books, et cetera. And I think the reason I have that comfort is I'm thinking the third-party administrator is going to help identify maybe issues or bad data or red flags might come up when certain information comes across. Is that kind of really the case? Do you come across some scenarios where you might question a fund manager about data that's coming in, or some third-party administrators just, data in, data out, and is there really some protection or some reason for us to feel like there's comfort when a fund has a third-party administrator?
Yeah, I would say it's not a guarantee of nothing ever happening, and plenty of funds that had an administrator were able to figure out how to, dupe the administrator just like they dupe the investors. But it certainly is a plus, right? So I would say the answer is it foolproof? No, but is it a meaningful help? Yes. And I think it depends on the administrator. And it depends on, because we have had situations where we've had to terminate administration clients because either they couldn't, and most of the time it's that the information that they're providing us is either they can't provide it in a timely manner, it's just way too far behind, so that they're so incompetent as to be able to even deliver the information, or in some cases it's because they're misallocating the numbers, right? They don't understand their own documents and they're allocating expenses to the fund that are not allocable to that fund. So yeah, it's meaningful, but it's not a guarantee. Yeah, Pat.
So one thing that might be helpful for some people in this room, many of us have actually been involved with investing with several people for like 10 years. So, I think one thing I would ask them is if I was going to any manager and I didn't know they had a track record, I didn't know enough about them, I would ask them to give you some investors to call for reference. And, I think could be very helpful. I know we would certainly take a call and share our experience. So that might be very helpful.
Yeah. And we got about 1 minute, so maybe one or two more questions and then we need to keep moving.
Hey, Matt, as
Yes,
you do
sir.
your due diligence on the investor track record, there's been talk today about depreciation. Does that track record investigation also monitor or look back at their depreciation schedules?
No.
And have they?
No, we are not attempting. That would be an order of magnitude more work that would be next to impossible for us to perform, so. I don't think Quest, you could ask Quest, but my guess is that they won't be able to do that either. Any more questions? Yeah, one more right here. Final question.
In your experience, have you seen doubling down as an issue? Meaning, you've been with a manager for a while, Fund 2 was good, Fund 3 is good, and then you step up your engagement and, so I guess I'm saying the prior experience is very important, but also could be, in other words, do you see every new deal with fresh eyes? If you don't, what happens? In your experience, have you seen people making the mistake of doubling down with the manager, no matter what, and then suffering consequences?
I'm not 100% sure how to answer that question. I can think of managers that I know of that are very active right now that raise a lot of money that I wouldn't put a penny with, and they're out actively raising money. And people's argument for putting more money with them is that they've made a bunch of money the last 5 or 6 years, so they're putting more and more and more in. I think it's an individual case. I think there's value in diversification, so you don't want to have all of your money with one manager. Just prudence, right? But that said, you don't want to have too many because, it's hard to manage across too many. So I don't have a great answer for that question. I'm sorry. Okay, guys, we got to keep moving on. Hopefully that was useful.